Hey guys, welcome back to my channel. If you haven't already done so, go ahead and like, subscribe, and leave a comment of any content that you'd like to see going forward. So today I figured I'd be talking a little bit about a Schedule C, which is the form that you fill out when you are self-employed. So what that typically means is if you own your own business, if you drive Uber, if you drive Lyft, if you make your own YouTube content and then you're monetized and YouTube pays you money, then you need to file or pretty much fill out a form Schedule C, which is part of your 1040 form for tax season or for taxes. So today I'm just going to kind of go through a little bit about how to fill that out and what that's going to look like and pretty much what the expectation is. So pretty much the first section over here before part one is just regular, just fill it out. Name of your business. If you don't have a name for your business and it's just yourself, you're a sole proprietor, meaning you started your business by yourself and there's no forms submitted for it, then you can go ahead and put in nothing here. And then same thing for line C, line B, and line E. And then typically speaking, for a service-based business or for a really small mom and pop type shop, if you're not really a big operation, most people just use the regular cash accounting method. Accrual typically is used by some companies, not really that many. And usually if you have some kind of accounting software, you'd use an accrual system. Otherwise, you wouldn't really worry about it. So you just go ahead and skip these sections over here and then go right into part one, which is income. So for income, just typically just gross receipts or sales. So just the total amount of money that you made from your business. And this is based on however much is listed on your form 1099 MISC, as in 1099 miscellaneous. Or for 2020, there's also the form 1099 NEC, which is the 1099 non-employee compensation form, which you'd likely get from YouTube, Lyft, or Uber, which they consider you either a partner or a sole contractor. So they don't really consider you an employee, which is why you wouldn't get paid with a W-2 form, which means no taxes at all were withheld throughout the year. So you would put the entire amount of money that you made, gross receipts, over here that are either listed on the form or that you just had as a cash balance. So the reason you'd want to list cash income, say you started YouTube this year and you only made like $30, but your expenses were over $1,000 because you bought a camera, you got some kind of like website subscription or partnership or something so that you could create your YouTube thumbnails, YouTube content, then it would be more beneficial for you to list that business or list that income so that you can expense it. And what that means is you can expense your business income until it hits zero so that none of your business income is taxed. So take out, I think I said $3,000 of expenses and $30 of actual income. You can expense that full 30, but whatever extra loss that you have over from your business you can carry it forward to next year for your business, or you could use it to offset any other income that you had. So say you were working at Deloitte or you were working at some place where you were making good money and you wanted to expense that money, you'd probably use whatever is left over from your business in terms of losses. And over here is where I would say part two, where you'd put your expenses, and there's categories broken down because these are what would be considered ordinary and necessary for your business. And you'd want to be very careful about what expenses you include, as in don't go too crazy adding a bunch of expenses that don't exist because that would trigger an IRS audit. So what that means is they'll look through your return and look at these expenses and ask you for proof. So if you don't have the proof or you don't have an actual breakdown of the amounts that you spent on these things and you don't have a very valid estimate and they're not necessarily ordinary, then I would recommend that you don't include those there. So you can't just throw in a bunch of expenses to get a tax deduction. You have to actually make sure that these are things that you purchased, these are things that you have proof for, and that these are things that you can account for when the IRS audits you if you do get audited, because they look at Schedule Cs a little bit more heavily than other areas of tax. So once you've included all of those things here, then it'll give you the total expenses, and then it'll show you on line 29 the profit or loss that you had from the business. If it's a loss, it'll carry over to the rest of your taxes. If it's a gain of some sort, then you're going to owe tax on that amount, and it's going to go into your adjusted gross income. Now, cost of goods sold, this is for if you had a business that involved some level of inventory. So you'd pretty much put these types of information in there. And whenever you have cost of goods sold, it does have a little bit more steps or information. And just for the sake of this video, I'm not going to go over it a little bit in too much detail. But just like it says on this form, these are the things that you'd put in, because you could either use the FIFO method, the LIFO method, which means first in, first out, or last in, last out, which both very much differ, and those typically follow through on an accrual basis. And then lastly, you'd put in information of your vehicle. If your vehicle is used for business purpose, as in it's solely used for business purpose, and if it's not solely used for business purpose, that you're keeping track of the mileage that you spend exactly, or a really decent estimate of how much of your mileage that you are using on your car to, say, get from one point of business to another point of business. If you're going from your home to an area of business, generally speaking, as a business, then it's deductible. But if you're going there for like your job, let's say I went to the office today and I work in an office and I get paid with a W-2, that mileage is not considered a deduction. So I would not include that. Now, where it says other expenses here in part 5 ties back into this area in part 2, where it says other expenses. This is just a summary of whatever is listed in part 5 for other expenses. And other expenses are typically things that aren't listed above, like if I'm using my cell phone for business, like since we're all working from home and that's a big part of things, then I would estimate how much of my phone I'm using for business. If I'm fully having like a second phone from business needs, then you could list that whole expense here because you bought it this year. If not, then just a portion of the monthly bill that you use for the phone. So say a good estimate, if you do most of your business on your personal phone, would be 50%, because it's a safe number. So 50% of your bill for your phone could be something that you expense over here. And that's pretty much the entire form. And like I said, again, be very careful of what you include in your expenses, just because you may trigger an audit. And just because you may not be audited in 2021 does not mean that you're not going to get audited. Typically speaking, you want to maintain a good record of your expenses and of your income, especially when you have a business, a side business, because you can be audited anywhere from 10 years from the point of filing. So once the IRS receives your taxes for 2020, they have about 10 years to go ahead and audit that information. So make sure that you keep that handy, you keep it on you, keep it safe. All right, that's it for this video. So let me know if there's any other content that you'd like to see going forward, and we'll see you next time.